In this video, we'll talk about the basics of accounting for inventory. First, we'll cover the basic journal entries and T accounts involved. We'll talk about the cost flow assumptions. There are 4 different cost flow assumptions that we'll learn. And finally, we'll talk about impairment of inventory balances. First, let's talk about the basic journal entries. And these are all the journal entries you need to know about accounting for inventory. First, when a company acquires or produces inventory, that is, they either buy inventory from some third party or they spend money to produce their own inventory, they debit an inventory account on the balance sheet. Inventory is an asset account. And they credit, let's just assume they're paying cash to acquire or produce inventory. So they'll reduce the cash account and they'll increase the inventory account on the balance sheet. These are both asset accounts, and we're creating this asset. Why is it an asset? Well, because inventory is going to give us a future economic benefit, and so we consider it an asset of the business. That's the first journal entry you need to learn. The next one is when we sell inventory to our customers. And so when we sell inventory, we credit the inventory account on the balance sheet. We reduce it because now we don't have the inventory anymore. And we debit an income statement account called cost of goods sold. And this is typically the second line item on the typical income statement. You'll have revenue at the top, which is amount you've earned from customers. And then right below revenue is cost of goods sold. So what did it cost you to produce or buy that inventory? So a debit is to the cost of goods sold income statement account. And we will also use this same journal entry when we do inventory impairment. So if we sell inventory, we credit inventory and debit cost of goods sold. And also if we impair inventory, and impairing inventory just means our inventory has lost its value, so we need to reduce the asset value. We'll credit the asset to reduce the asset, and again, we'll debit cost of goods sold to send that cost into the income statement. Okay, so it's the same journal entry for an impairment. These are the 2 journal entries you need to learn for accounting for inventory. And here is the inventory T account. Inventory is an asset account, so you'll find it in the asset section of the balance sheet. It's an asset account, so it's got a normal debit balance. So you'll find the beginning balance on the debit side of the T account. When a company acquires or purchases inventory, whatever the cost of that inventory was is a debit to the inventory account. And typically it'll be a credit to cash or accounts payable, depending on if you paid right away or you'll pay later. But the debit is right here in the inventory account. And this is for the cost. The cost of the inventory. Okay, what did it cost you to acquire or purchase that inventory? Next, when we sell inventory, we will credit the inventory account, reducing it. So we'll credit inventory, there's the credit, and the debit is in the cost of goods sold income statement account on the income statement. Okay, so that credit reduces inventory for the cost of the goods that we sold. And also within this same box would be an impairment of inventory. Okay, and finally we'll have an ending balance also in the debit side of the T account. So we'll start with a beginning balance on the debit side. We'll add the cost of what we acquired or produced or purchased, the inventory that we produced or purchased. We'll subtract the cost of the inventory that we sold, and we'll get to the ending balance as a debit in this inventory T account. Okay? Now let's go through some cost flow assumptions, and we're going to use an example here. And the example you see on the screen is the Yeti cup. Okay? And of course, we're going to use mint green because that's the color you should buy if you buy a Yeti cup. And we're going to imagine that we're a company that we're going to buy Yeti cups, and then we're going to sell them to our customers. Okay, so we're going to buy them from the manufacturer, then we're going to sell them to our customers. And the first thing we do is we buy an initial shipment of 3 Yeti cups so we could put them on our shelves. Okay, and Yeti, the company, charges us $1 per cup. Okay, so we pay $1 per cup. We pay $3 for these Yeti cups. We'll debit inventory for $3. And we'll credit cash for $3 because we're paying cash. Well, now we're starting to think these are going to be popular, and they are because it's a really good color cup. And so we're going to buy another round of Yeti cups just to make sure we're fully stocked. But Yeti has also caught on to this demand situation, and they've increased the price of their cups up to $2. So now when we buy a Yeti cup, we have to pay $2 each. Okay? So 2 plus 2 plus 2, that's $6 for this next shipment of 3 cups. So now we're debiting inventory for an additional $6, crediting cash for $6. And demand has really gone crazy, so we're actually going to buy a third and final shipment of Yeti cups, and now the price has gone all the way up to $3 on these cups. So now we're paying $9 for this final shipment, okay? So the total amount we've put into inventory is $18 worth of Yeti cups. Some of them were pretty inexpensive, but the ones we bought recently were very expensive, okay? And this kind of increasing of input prices, this is very common. You know, it's kind of called inflation. Input prices generally tend to increase over time, and that's just an on-average statement, okay? It's not true for every industry and every time period. But anyway, for accounting purposes, the cost of the inventory that we have available for sale is $18. So now let's go about selling these cups. And let's say a single customer comes into our store and buys 2 of these cups, okay? They take them off the shelf. And these that are in the square, these happen to be the ones that the customer picked out to buy, okay? They picked out a $1 one and they picked out a $2 one. Now we're charging the same price for these cups, okay? Let's say we're charging $5 for these cups. So the customer's going to pay us $10 for 2 cups. But these cups actually had different cost bases depending on when we bought them, okay? They're identical in every other way, but they cost us different amounts. So what do we do as accountants when a customer buys these 2 cups? Well, it depends on what cost flow assumption we use, okay? And I'm going to teach you 4 cost flow assumptions. The first cost flow assumption is probably the easiest. It's called the specific identification cost flow assumption. And the question is, what should we record as cost of goods sold? And under the specific identification method, cost of goods sold is just the exact cost of the units that were sold. So we sold a $2 unit and we sold a $1 unit. We'll put those exact costs into cost of goods sold, which I abbreviate here as COGS. So put the $2 unit into cost of goods sold and the $1 unit into cost of goods sold. Cost of goods sold is $3, okay? So we'll debit cost of goods sold for $3 and credit inventory for $3. What will be left on our balance sheet inventory account at the end of the period? Well, we had $18 worth of inventory at the beginning of the period. We sold $3 worth of the inventory. Now we have $15 left in our ending inventory balance, okay? That's the specific identification method. You just figure out what you paid for that item, and that's the cost that goes into cost of goods sold. Next, we'll talk about an average cost method. Now, for the average cost method, we kind of disregard, we don't really care exactly which. So here's me scratching out the box that shows you which ones they bought. Okay, we don't really care which ones they bought. What we do is we just compute an average cost. What did these cups cost us on average to buy? The average cost is equal to the total cost in inventory divided by the number of units that we have. So the total cost was $18. We have 9 total units. So the average cost here was $2 per unit. So when a customer buys 2 cups, we just put the average unit cost into cost of goods sold times the quantity. So the average unit cost is $2 per cup. The quantity was 2, and so we'll put $4 into cost of goods sold. That's a debit to cost of goods sold and a credit to inventory when we sell those cups. In ending inventory on the balance sheet, we'll have the $18 we started with minus 4, which we sold, and we'll have $14 left on our balance sheet, okay? So always here, I'm talking about the income statement when I talk about cost of goods sold, and I'm talking about the balance sheet when I'm talking about ending inventory. Okay, 2 more methods left. The next one is called FIFO, and FIFO stands for first in, first out. And this method assumes that the oldest units are the first ones that we sold. So the first ones that we bought are the first ones that we sold, FIFO. Well, if you remember, the first ones that we bought were these $1 units, and so we'll assume that we sell these $1 units first. So when a customer buys 2 units, again, we disregard which ones they actually bought, and we just assume, this is our cost flow assumption, that they just bought the first ones that we bought, okay? So our customer buys 2 $1 cups. So what goes into cost of goods sold? 2 $1 cups for $2 goes into cost of goods sold on the income statement, And left in ending inventory is 18 we started with, minus $2 that we sold. $16 is left in ending inventory. Okay, that's called the FIFO method. Now, if a customer would have bought 4 cups, just for example, if a customer would have bought 4 cups, we would have sold these 3 $1 cups first, then we would move to this $2 cup. Okay, that would be the 4th cup we sold. And in that case, so if we bought 4, okay, cost of goods sold, if a customer bought 4, cost of goods sold would be 1 plus 1 plus 1 plus 2. You see that? So cost of goods sold would have been $5 if a customer bought 4 cups. Okay, so you just work your way up the layers in FIFO. And you might be able to predict the last cost flow assumption. It's called LIFO. And LIFO stands for last in, first out. And this method is the exact opposite of FIFO. It assumes that the newest units that we bought are the first ones that are sold to the customer. Okay, so again, we ignore the 2 cups that the customer bought. Okay, we ignore what they bought in particular. We assume that the last ones that we bought are the first ones that they bought. Okay, so we're going to sell those 2 $3 cups. And it'll go 3 plus 3 is $6 of cost of goods sold. Ending inventory is $18 we started with, minus 6, $12 is left in ending inventory. And again, if a customer bought 4 cups and we're using the LIFO method, cost of goods sold is going to be 1 to the 2 $3 cups, the 3rd $3 cup, and then 1 $2 cup. Okay, so we just work our way down the layers. So if a customer buys 4, it'll be $3 plus $3 plus $3 plus $2 in cost of goods sold. And that's 9 plus 2 is 11. Okay, $11 would have gone into cost of goods sold if a customer would have bought 4 and we're using the LIFO method. Okay, so these are, now we're finished going through the 4 cost flow assumptions that we'll learn in this class. Here's just a table to show you the result of these methods. Specific identification, here was our cost of goods sold, here was our ending inventory balance, average cost, FIFO, and LIFO. And something I want you to notice here on this slide, and this is just kind of a general rule, and it's generally true that input prices increase over time. If that's true, input prices are increasing over time, and as long as you're not selling more than you purchased, then it will be true that the FIFO cost of goods sold will be lower than LIFO cost of goods sold, okay? Because if input prices are going up and you're using FIFO, well then those small early costs are going into cost of goods sold. If input prices are going up and you're using LIFO, well then those high later costs are going into cost of goods sold. Why would a company want to use LIFO? It seems like it's making cost of goods sold really high. Well, the answer is this is actually one of the few accounting choices that flows through to income taxes. So companies really like using LIFO on their income taxes because they take big cost of goods sold deductions from their taxable income and it reduces the amount that they have to pay tax on. So they actually like to have a lot of cost of goods sold on their income tax return. And if they use LIFO on their income tax return, they're required to use LIFO for accounting purposes. Okay, that's called the LIFO conformity rule. That's why you'll see some companies using LIFO, even though it makes generally, because input prices increase, generally makes cost of goods sold higher than it otherwise would be. Okay, we've gone through the cost flow assumptions. Finally, we're going to talk about inventory impairment, and this is called the LCM rule, or the lower of cost or market rule. This occurs at the end of an accounting period, okay? So you get to the end of a period, you look at inventory on your balance sheet, okay? Let's go back to this prior slide. Here's what the ending balances were, depending on which cost flow assumption we're using, okay? These were the ending balances on our balance sheet. So you look at that balance and you decide, does the balance here in inventory, can I get customers to pay that amount for this inventory? Or did I pay way too much for that inventory and there's no way I'm going to be able to sell it for that amount, okay? And we implement this thinking using the lower of cost or market rule. So the inventory balance must be the lower of whatever it cost to make the inventory or whatever that inventory's market value is. And let's just look at an example that'll be easy to see. Here is a pre-impairment balance sheet. Okay, so you could call this an unadjusted balance sheet. Okay, we haven't done our year-end entries yet, and we're using the LIFO method. Okay, and so our inventory account before we record an impairment, before we even decide if we need an impairment, is $12. Okay, and I'm getting that just from right here. That was our ending inventory balance under the LIFO method. So that balance is sitting at $12 at the end of the year. The question is, do we need to impair that inventory? In other words, we have 9 minus 2, we have 7 cups left. Are we going to be able to get $12 for those cups or not? And that's the question we're answering with the impairment test. Well, that requires an estimate. And so the accounting department will estimate the inventory's market value. What do we think we can sell these customers for? These cups for? What do we think we can sell these cups for? Well, we think we can sell them for $20 in total. So these 7 cups, we think we'll get $20 from customers. Well, hopefully your intuition is kicking in here and saying, well, that $20 is sufficient to justify a book value of $12. We're telling investors we have this asset of $12. Is it worth $12 or is it worth less? Well, it's worth at least, we think it's actually worth $20. So it's fair to show that we have at least a $12 asset on our balance sheet. In other words, no impairment is necessary because the inventory balance is stated at the lower of cost or market value. The lower value in this case is the inventory's cost of $12. The market value is $20. Now let's change our assessment here. Now let's suppose that the accounting department thinks about it. These cups are probably going out of style pretty soon, and you're not going to be able to sell them for as much anymore. And suppose the accounting department picks up on that fact and now decides that these 7 cups that are left, I don't think we're going to get more than $10 for these cups that are left. Well, now we have to decide, what is the lower, cost or market? The cost was $12. The market value is $10. So the lower of the cost or market is now $10. And now we need an inventory impairment. Inventory must be stated at the lower of cost or market. So this inventory balance needs to go to $10. How do we make that happen? Well, it's that same cost of goods sold journal entry. Debit to cost of goods sold and a credit to inventory, reducing the inventory balance by that $2. And here's the post-impairment balance sheet. So now the inventory balance has been reduced to $10. And we have this $2 additional of cost of goods sold showing up on our income statement. Okay? So just to recap, in this video, we first talked about some of the journal entries and the T account for inventory. Then we talked about the inventory cost flow assumptions, specific identification, average cost, FIFO and LIFO. And finally, we talked about the LCM rule, which says that inventory on the balance sheet must be stated at the lower of either its cost or its market value. Okay?